As the US and Europe grapple with a burgeoning banking crisis and brace for more potential bank failures, the de-dollarization trend is accelerating, led by the BRICS countries. Brazil, Russia, India, China, and South Africa continue to move away from the US dollar. China and France just completed their first liquefied natural gas deal settled entirely in Chinese yuan. China and Brazil have reached a deal to trade in their own currencies, ditching the greenback as an intermediary. Meanwhile, Chinese President Xi Jinping recently met with Russia's President Vladimir Putin, with both vowing to significantly increase international trade in yuan instead of dollars. Both leaders advocating for the use of the yuan in settlements between Russia and Asian countries, Africa and Latin America, and calling for a new era and, quote, changes that the world hasn't seen in 100 years. So the world's second largest economy and its largest energy exporter are together actively trying to dethrone the dollar. Now, the trend towards de-dollarization has hastened follows Russia's invasion of Ukraine and the weaponization of the US dollar through sanctions. In August, the BRICS nations will be discussing the development of a new reserve asset to rival the US dollar, as well as the possible addition of new members to the alliance, including Saudi Arabia and Iran. Now, China recently brokered a deal between Saudi Arabia and Iran to resume diplomatic ties. Meanwhile, Saudi Aramco is building a $10 billion oil refinery complex in China, adding further speculation that the end is nearing for the petrodollar. And of course, this is all happening as the state of the US financial system is looking increasingly unstable. Well, joining us to unpack these developments is Lynette Zang, Chief Market Strategist at ITM Trading. Lynette has almost 5 decades of experience in the financial sector, including as an investment banker at Lawson Lehman and American Express. Lynette, very good to have you back with us.
I'm happy to be here, Michelle. Thank you for having me.
All right, well, we need you to help us unpack all of these developments. There is a lot to discuss. And in fact, so much has happened since we last chatted, which was late January, including, of course, the big developments that the second largest and third largest bank collapses in the US history took place, Silicon Valley Bank and Signature Bank. Now, federal regulators have been on Capitol Hill the last few days trying to explain exactly what happened to lawmakers. But why don't we get started with your take on exactly what happened with the collapse of SVB and Signature Bank?
Well, they look, in the 90s, they allowed investment risk-taking banks to merge with deposit-taking banks. I haven't heard one person talk about removing that link anymore. They just talk about more regulation, and they talk about, bringing back Dodd-Frank, except that they only had 70% of it written, and that doesn't mean that it was actually put into service. So I think a lot of that is just a lot of jawboning. This is about bank profits. And when you see the fact that the head of SVB sat on the board at the San Francisco Fed, and then we are wondering why the regulators weren't in there more aggressive, well, I kind of think that we can see why that's true. And also the fact that he sold a whole bunch of stock shortly before SVB went down. But the level of leverage and that bailout. Now, they don't want you to think that it's a bailout because they say, taxpayer money wasn't used. And they keep talking about the DIF fund, which is the FDIC's fund to pay out depositor insurance, but there's only $128 billion in there. And the Federal Reserve, behind everybody's back, and I haven't heard one other person talk about this, as far as on any of these meetings or even ask this question, but the Federal Reserve actually went to the Treasury and borrowed $184 billion, gave $148 billion to the FDIC, or loaned it to them, to the FDIC to bail out all of the depositors in Signature Bank and SVB Bank. So in 2008, they bailed out the banks. But who did they bail out this time? Venture capitalists and technocrats, technology companies. Who do they need to help them bring out the central bank digital currencies? Oh, they need venture capitalists and they need those technology companies. So as they are systemically important, but there was no oversight on it. I mean, they've been dismantling Dodd-Frank and any oversight since Dodd-Frank was really written. And let us not forget that, 20 or 21, we went into a no reserve requirement system. So the banks, so that they have more to trade with, because that's how they're generating so much of their income, but they have absolutely no reserves set back for a crisis like we're going through. But, so there's a lot in there.
A lot in there. And you've just given me just a lot just in that one first answer, Lynette. I want to circle back because I'm watching the CBDC angle very carefully. So you're saying that you think that there was an incentive to bail out Silicon Valley Bank intentionally because you believe that some of the players there may be important to the technological rollout of a potential central bank digital currency?
Yes, I do.
But this is speculation. Or is there any link of particular companies or people that were bailed out that are actively helping with some of the technological processes that perhaps are being looked at or laid down?
Well, considering that it's the technology companies and Silicon Valley that got bailed out, I don't have necessarily a specific name. However, yes, I mean, it makes sense. It's logical. They're systemic, and they had a lot of, 97% of their deposits were uninsured deposits.
Yeah.
They got bailed out at 100%. Kind of reminds me of when we bailed out AIG 100%, and their counterparties on those derivatives were Goldman Sachs, all the usual players. So no, I don't have a specific name, and it is my opinion. I cannot prove that, but logic kind of is there.
I just wanted to clarify that point because, Lynette, so often you do actually have very concrete data to back up everything that you're saying. So I just wanted to clarify that this is more a sense of intuition, which is something to be taken seriously as well, but not necessarily any precise data. And there's been a lot of speculation as to why SVB in particular has been bailed out. I mean, some have even argued that a lot of the donors to the Democratic Party were involved in that particular circle of people that were banking at Silicon Valley Bank. You're saying potentially it's because the technology companies may be involved in this idea of a central bank digital currency rollout. But again, that's purely speculation on both counts. But what is not speculation, what we do know for a fact, is that up until then, the FDIC insured everything up to $250,000.
Yes.
And since that collapse, the FDIC insured deposits until however high they went, both at SVB and at Signature Bank. Now, the FDIC, the Fed and Treasury stepped in to make all of the depositors in those banks, including the uninsured ones, 100% whole, exceeding that usual $250,000 limit. So are we to assume now that bank deposits over $250,000 and beyond are insured by the FDIC? Because we've been getting a lot of conflicting messages here, including from Biden, including from Yellen, and including from Powell. So where do things stand there?
Well, and the way they presented it, you're right. It's conflicting. It sounds like 100% of all deposits were going to be insured, except that once you give somebody something, you take it away and there you have your bank run. So it's only those that they deem systemically important, which is really hurting the community, the small community banks that really support the economy on a much broader scale. And Yellen has said, no, we have no intention of doing 100%. So if we look at what happened between 2008 and 2011, well, what were the banks that really failed? Yeah, we had Bear Stearns, so that was a big one, but most of them were community banks. And because the little guys, the little depositors, most people don't have more than 250,000 in the bank. So maybe they're sitting there going, well, I'm okay because I'm below that limit. But the reality is nobody is safe. Nobody is okay. And if they don't think that you are systemically important, then they're happy to pull the plug on you. If you're big enough, no.
Right. Now, last time you and I chatted, we discussed the idea that, in fact, according to the regulation, the FDIC was able to enact a so-called bail-in, which allowed banks to use depositor funds to rescue themselves from failure. And this was legally the process on the books there. You also highlighted back then that the FDIC lacked the money to bail out depositors in case of significant bank failures. Why did we not see the FDIC invoke this bail-in clause at this time? Is it because it would have just created mass panic, hysteria, and accelerate the run on the banks?
How many people actually heard or knew about Signature Bank or SVB until this whole thing happened? Most people have no clue about who they are. So if they had bailed that excess money in, then it probably would not have created a run. I don't know that because they didn't allow that. So that's what makes me wonder about the ulterior motive. Why was that suddenly systemically important? And they've known about it. They've known about the problem there for more than a year. And they did absolutely nothing about it. Though, again, the head of the bank was sitting on the board at the San Francisco Fed. Now, I don't know that he had any influence because I don't sit on the board, so I can't hear this. But I don't know. Is it just a coincidence that they got bailed out? Would that really have created more runs if they had honored that $250,000 level? Because again, most of the public don't have more than $250,000 in the bank, right?
Yeah. Most of the average people do not have more than $250,000 in the bank, although there is now discussion to officially raise that limit, because I believe the last time it was raised was in around 2010. So arguably it is due an increase, but more importantly, help our viewers understand where this money came from in the first place. Because you said that there was a $148 billion fund created after $184 billion was made available to the FDIC. So explain that process to us and where exactly that money came from.
That money actually came directly from the Treasury.
Okay.
So the Federal Reserve was working with the Treasury, borrowed $184 billion from the Treasury. Now, they're also showing losses because a big part of the problem, although, again, keep in mind, the Federal Reserve is supposed to oversee these banks, and they certainly knew that they were raising rates. And yet, they didn't know that this was going to create a problem, not just with SVB Bank, but that was the problem, because when you raise rates, the principal value of the bonds that they're holding, that they bought near zero interest rates, that principal value declines very substantially. So when depositors went to pull their money out, then SVB had to sell these Treasury bonds that were underwater because the Federal Reserve is raising rates. And yet they didn't test any of the banks for that scenario.
And why do you think that is?
This is my opinion. I cannot prove this. But, the assumption is that the Federal Reserve always wants things to continue on and continue on. But I think they only needed to continue on until they have those CBDCs and everything in place to shift us into a new system. Plus, we have the transition on the interest rate benchmark coming up. And this is not my date. I don't give dates because that's way beyond my pay grade. But when a central bank, the Bank of England, says the cutoff is June 30th of 2023, then I have to believe them and go with that. And that's what we were talking in January. I said there has to be a big crisis before then, because they cannot make, I don't believe they can make that transition. That is a huge experiment. And the most current data that I've been able to find on this, out of every 6 contracts, 1 has the new benchmark in it. 5 still have to transition. And look at where we are. We're March.
All right, let me just help our viewers understand what it is you're talking about for those that did not watch our previous interview, where you did actually say that you did foresee some kind of crisis to help with the transition from LIBOR, that's the London Interbank Offered Rate, to SOFR, the Secured Overnight Financing Rate. And these rates are used as benchmark rates for banks to conduct trading, as well as to set the terms of loans. So why is it so important now that US banks are supposed to transition using just SOFR by June? And why is this a potential problem? Why was there a crisis, if you will, needed to help facilitate this?
The problem is even with all of their funny antics with creating a new benchmark and then creating some accounting tools to try and get it to match the LIBOR, which all of these contracts, all of these debt instruments and these loans and derivative contracts are based upon the value of the LIBOR. Their value is based upon the LIBOR. But that is supposed to be no longer reported after June 30th. And so all of the contracts would then be attached to SOFR, and they have not been able to come up with a formula to make them match exactly. And so the value of all of those contracts are about to shift overnight. And each contract might be off pennies on the dollar, which doesn't sound like a lot, but we don't even know how many of those contracts are actually out there. At one reading, it was 610 trillion that still needed to shift over. But, I found this, the Office of the Comptroller of the Currency runs a quarterly report on derivatives in the FDIC insured banks. And in their most current report, FDIC banks have paid $180 trillion, and I'll come back and explain this a little bit more, to compress or consolidate what the market sees as a derivative trade. Now, what I mean by that is in 2013, they wanted to hide. I mean, that's the thing. I can't say they wanted to hide, but after what happened in 2008, and this market that this is what imploded in 2008 was the subprime derivative market.
Yeah.
And after that, they wanted it to look smaller than what you and I could see. It's a way to hide what's really happening. And I have read in a lot of their materials where they'll say, if we make this really complicated, then nobody will question us. And think about it. Most people, when they're talking about money and they're listening to all of this stuff, they just go, oh my God, well, I don't understand it. They're smart. They understand it. But the problem is they make it so complicated and complex. And everybody admits, so the FDIC, the BIS, the IMF, the Federal Reserve, the World Bank, every single entity admits that no one truly knows the value that is at risk, because the price and the price movement is based on the price action of the underlying asset. It could be stocks or bonds, other derivatives, the weather, credit quality, could be all different things, right? So the problem is that nobody really knows how big this is, but they spent $180 trillion to make it look to the markets like there's only 9 trillion in derivatives. That means that they had to have saved more than 180 trillion in fees that you have to pay to keep these things floating. And since so many derivatives are leveraged at 1,000 to 1, I mean, that goes past quadrillions. But that's the value that any of these bank stocks or corporations that are holding derivatives, their value is tied to the value of all of these contracts. And when we make this transition from the LIBOR to the SOFR, the value of all of those contracts will shift overnight, those that have not already been changed, and more have not been changed to hold that new language in there. And that's why the markets had to be forced to adopt SOFR. They didn't want to adopt it. You have a number of entities, particularly in the leveraged loan and the collateralized loan obligation derivatives, that are fighting this because of that valuation change. And that's tectonic because nobody even knows how much that is.
All right, again, another giant package to try and unpack there, Lynette. So you're saying that banks have been spending $180 trillion to hide or compress $185 trillion in derivatives, which doesn't really make sense. Firstly, what do you mean exactly by compress or hide? Just elaborate on that further.
Okay, what they'll do, I'm going to make this really simple, but what they'll do is, here is a derivative contract, let's say it's worth $1 trillion. And it's based on interest rates because most of the derivative contracts are for trading and they're based on interest rates. Okay. So it's $1 trillion contract. Here's another $1 trillion contract that is maybe also based on interest rates, but they're not exactly the same. But in a compression, they'll go, okay, well, this $1 trillion offsets this $1 trillion. So instead of 2 trillion, we have 100 billion.
You mean if they're taking different sides of the same trade? If the contracts are taking different sides of the same trade, more or less, you can write them off against each other?
It's not necessarily even different sides of the same trade. These are just similar trades that they compress it kind of like into a hard center of a bomb, right? A whole bunch of gunpowder is compressed into the center of the bomb that you can't see until that bomb explodes. But for all of these trades, the FDIC banks have to pay fees. And so to reduce those fees, give them more money to do this stuff with, they make it look like there are not as many derivatives out there.
So what would happen to cause this bomb to explode, to bring out all of these hidden derivatives to the surface, to see the extent of just how deep this iceberg runs?
Right. Well, one of the things is the Federal Reserve and global central banks really being between a rock and a hard place and trying to raise rates to fight inflation at the same time. And they can't do it. Every time they've tried, it's been a failure. But think about the fact that we were in zero interest rate policy for 15 years. And so a lot of those bonds and a lot of those derivatives based on that zero interest rate policy is now unwinding. Mm-hmm. Okay. And we can't see it because that's a very opaque part of the market. We can't see that. And unfortunately, we won't see it until it's too late to do anything about it. Just like when JP Morgan took over Bear Stearns in March of 2008, the public didn't really see much about what was going on. It wasn't until Lehman collapsed in September of that year, then the public became aware. And it's this same kind of thing. So what could cause that bomb to explode has already been happening for a year, which is the Fed and other global central banks raising rates, raising rates, raising rates. And it's all about credibility because, I mean, the reality is this is a con game and that requires confidence, which is why you see everybody trotting out saying every other word, the banking system is so safe, and yet they had to borrow massive amounts of money. The Fed turned around and went from QT to QE, even though their QT wasn't really working. So that's what could explode this bomb. And I think that there are a lot of little bombs that are going off right now that we cannot see.
Is that arguably, Lynette, why the speculation is that the Fed is going to have to pivot and start cutting rates?
They are, but it's not going to help. Because what's going to happen from there is the inflation is going to get worse and worse and worse. So, I mean, basically, they're darned if they do, they're darned if they don't, and they're darned all the way in between. This is the end.
All right. This is the end. But we've heard that before. As I say, we've heard that, this is the end before, and yet somehow the can gets kicked further and further down the road. I mean, the markets are up today. The markets seem to be happy with whatever regulators are telling lawmakers on Capitol Hill. The markets, for the most part, seem to have been lulled into a false sense of confidence, or at least calming down a little bit. What is that about? Is that just denial?
Actually, I was there on Black Monday in 1987, and after that, they created the plunge protection team. And I'm not necessarily, and again, I don't have hard data on this, but I'm not necessarily convinced that it's mom and pop that are in these markets. I think it's traders, very short-termism, and I think it could also be part of the plunge protection team because mom and pops notice when they open up their 401k statement and it's dropped a lot. They notice when inflation is rising really fast. And so they need to keep the public calm because that is the last vestige of confidence that there is in these markets. So, I think it's about keeping the public calm, and I'm not convinced that it's just traders that are doing this. They just don't want you to know.
So you think what? That there are...
I think the plunge protection team is definitely at work in these markets to make them appear more stable than they are. But when you look at the range
what do you mean by the plunge protection team? Elaborate on that. You mean government-funded, traders pumping up the market?
Yes, absolutely. Yeah, that was created after Black Monday in 1987. Black Monday was in 87. Right after that, because the markets imploded 25% in a very rapid period of time. I was there. I remember that very clearly. And then I remember shortly thereafter, the government, which includes the Treasury, it's all the usual players, the Treasury, the Federal Reserve, the OCC, all these guys, they created the plunge protection team. So taxpayers actually fund this and they can go into the markets and they can buy. And a lot of what's getting bought are derivatives because you can control a lot of wealth in a very small, for a small amount of money. Just look at gold, for example. 500 ounces of gold is somewhere around $1 million or something like that. But yet it costs like $150 to control that. That's leverage. Right. So that's what is happening a lot is through derivatives, which are a lot less money to takes up a lot less money, but it can control a lot of wealth and what you and I see when we look at what the markets are doing.
Right. And we have had various guests on the show speculate that there is manipulation of the gold price and the silver price through the derivatives market. But you're saying that you suspect that whatever support we may be seeing in the equity market may be through some sort of government sanctioned players, the plunge protection team, as you say. And I know that there's a working group on financial markets nicknamed that. Their official mission is to advise the US president during times of the economic and stock market turbulence. But you're saying that you think that they're going beyond that and are supporting the market through derivative trades.
Yes, absolutely. And there are also day traders in there. So I'm not going to say all of it, but I'm going to say a substantial amount. That's their job, is to keep those markets on an even keel so that the public doesn't really see what's happening. And that is their job.
All right. Well, I'll tell you what the public will see, and that is if the debt ceiling doesn't get raised. Because as we move to SOFR in June, as we have the FDIC borrowing these billions of dollars from the Treasury, which was a bypass of getting the debt ceiling raised in that particular case. But we do have that debt ceiling deadline looming. And if Congress doesn't agree on raising the debt ceiling, then there could be a government shutdown. We have a very, very divided Congress at the moment. So how do you anticipate that happening? It kind of seems to me like you have a perfect storm of events which spell trouble for the financial system and spell trouble for the US dollar.
Yeah, absolutely, Michelle. And that's why I say when you look at the choices that are being made, they're really destabilizing on so many levels. And when you stop and think about the fact that it took more to bail out 2 banks than the entire fund to bail out all of the banks, you're starting to see a picture. But this is why I say I am not convinced that they're trying to even kick the can down the road.
And you're saying, again, that this is by design, that this is...
It could be.
And I've had guests on the show echoing a similar sentiment. And I always like to say that there is the expression, I've used it before on the show, don't ascribe to malice what could be explained by stupidity or by inefficiency. But you're saying that you believe that this is now, by design, creating a chaos in order to bring down the system.
Yes, because there's virtually no purchasing power left. Officially, there's virtually no purchasing power left in the currency, and they can't raise interest rates, which is their key tool. And they've given away. I mean, this blew me away when I saw them do it last August, which is not that long ago. It's not even a year, when they gave away the market confidence in the central bank, that the central bank had their back. And what are the global central banks saying, whether it's here or it's in Europe, is that the central banks are more concerned about fighting inflation, which of course they never say the inflation that we created and caused, but they're more concerned about fighting inflation than they are about the markets, which I don't really necessarily believe. But I think that they're fighting for some semblance of credibility. And okay, sometimes it could just be stupidity, but doesn't it kind of seem like there's stupidity in every area? There is only so many. There are only so many missteps that you can start to explain by just sheer ineptitude. And again, going even back to some of the moves on the geopolitical stage, which I want to get to as well, which kind of also tend to make people question the value of the dollar, which is ultimately backed by the full faith of the US government, and people losing faith in the US government on the global stage also seems to be a big problem, as we touched on before. But before we get into that, on a very small micro picture in terms of the immediate future, what do you expect from the Fed? You're saying that the Fed does now somehow want to maintain faith with the public. So would that mean another rate hike? They may just do it in their arrogance. They can't raise it too much. What are they going to do? Maybe another quarter quarter point or something like that, because the system is already showing that it's breaking. And it's becoming very obvious. And how many more banks will go out? So I have no doubt but that a pivot will come, but that pivot isn't going to save anything. And I guess that's really the point, that we are clearly past, for me anyway, having lived inside of these markets for 1 million years, we are past the point of any kind of fixing. And what did we fix? What did we fix in 2008? We didn't. That was really when the system died, which is when I went on my journey for the food, water, energy, security, barterability, wealth preservation, community, and shelter, when I started building that out. And it was just put on QE life support with all of this money printing so that it made it look like everything was okay. But for a lot of people, they haven't even recouped from 2008, let alone from 2020.
All right.
So
to be clear, Lynette, you're saying that you believe it's by design, but yet you're also saying that the Fed wants to still maintain a veneer of credibility.
Right, because they want to stay in control. They want to be able to roll out that CBDC and remain in control.
Right. I mean, you used your money gun there, which required more resources, arguably, than the mouse click money from the Fed. And as we discussed, incompetence or stupidity or malice, well, we did have that unprecedented fiscal and monetary stimulus in 2020 or following 2020, with over 40% of the money supply created in just 2 years. And yet the Fed and the government were trying to tell us that this would not lead to inflation, and whatever inflation would come would just be transitory. Now, granted, there were supply issues in the war in Ukraine, but it was so obvious that this excessive money printing would lead to inflation, and that then you'd need to curtail that with aggressive measures, bringing us to where we are now. And that was just one of the many missteps, as we've been saying along the way.
Absolutely. And what are we hearing a lot about is these banks lacked liquidity. They were solvent, but they lacked liquidity. Well, where did all that liquidity go? Because prior to 2008, the Fed's balance sheet was at $800 billion. Now it's at $8.6 trillion, and that's after they tried to run off some of the bonds the treasury bonds that they had on their balance sheet. So they created this massive amount of liquidity. The inflation was held inside of the system, which benefited the upper echelon of society. The bottom, remember the K-shaped recovery, right? And that division between the haves and the have-nots have grown wider and wider and wider. This is absolutely by design. It was by design when they created this system, and they put inflation, embedded it into the system, because what did they say? Not one man in a million understands inflation. And guess what? Then you have Christine Lagarde, the head of the ECB, and you have Jay Powell, the head of the Fed, come out and admit that they really don't understand inflation either. Well, isn't that interesting? These are the people that are supposed to lead us. But yeah, they want to remain in charge into this new system. And, we vote with our purse. We vote with our wallets.
Yeah.
So if you buy stocks or bonds, or you hold your money in annuities and your savings account, all of that, that's your vote. If, however, you turn around and you buy physical gold, physical silver, and you take possession of it, guess what? Now that is outside of the system. And the gold is the only financial asset that runs no counterparty risk. What have we been looking at? It's all counterparty risk.
All right. I mean, look, Lynette, on the gold side, arguably, you could say that if the government really wanted to, it could come in and try and confiscate your gold, as it has done in the past. So there's always an element there. But, again, just to recap, just to clarify this, because I always like to distill things in a way that our viewers understand. Please. This is by design. You're saying a way to create an implosion within the financial system. You're saying by design, in order to lay the groundwork for a central bank digital currency.
And more than that, a complete social, economic, and financial reset of the system. Yes. And I've been saying.
Yes, you have. You have indeed. And again, I always like to say, by design, who is the mastermind of this design then?
Well, I'm not a conspiracy theorist, so I won't go higher than the biz, the IMF. So these are all unelected officials, central bank heads, treasury secretaries. So the World Bank, the World Economic Forum. So it's the 1% at the top that created it to begin with back in 1913. And it's not like there haven't been lots of experiments there. But they wanted to do two things, and they were very clear. If you read the documents when they were putting this whole fiat money system together, they knew that people marry the legal money of the state. So the dollar's never going to go away. No, it'll just be a different dollar, same name. So digital dollar, right? And they also knew that people don't understand inflation, and inflation causes nominal confusion. So people marry numbers. Oh, look at this. The markets are going up. They're paying attention to the numbers. Mm-hmm. But at the same time, the value of this stuff is going down, and it's going to zero, because that's what happens 100% of the time. They don't want you in real money, because that's how you counter this. This is under their control. This is not. Now, it takes 12 to 18 months to go through the system. That's why we're seeing the banks starting to crash now, because when did the Fed start raising rates? About a year ago, roughly, right? So we're seeing the policy lag. We're seeing the impact of that. And what we're seeing is just the beginning of the impact of that. Will they raise rates more? Maybe, because they want the public to think that they really are fighting something. Mm-hmm. But when they turn around and choose who are the winners and who are the losers, like they did in 2008, like they did with Signature and SVB Bank, and even in 2020, when they did all that stimulus, it was so that the public could keep spending. Right? They didn't really, the public didn't get nearly what the corporations and the businesses and the banks got, the large ones. Right? So by design, 100%. And that was the beginning. 1913 was the beginning, and this is the end.
Let's put a timeline on this when you say the end. I've had guests on the show, like Edward Dowd. He's saying he thinks by 2025, he thinks it could happen as soon as by 2025 that we'll have the banking system break down into 6 national banks here in the U.S. What do you think?
I think that that's highly probable, and I don't think we're done with crises for 2023. Right. And I think that we need a big enough crisis so that people will agree to this next iteration, the CBDCs, because they've told us how they're going to sell it to us. And they're going to say that this will eliminate inflation. Right. It'll usher in massive deflation because they intend to go to negative rates. And that's how they're going to control you. But it also takes the world into a full surveillance economy that can be controlled directly by the central bank if all of your wealth is held inside of the system. They're going to say jump, and you're going to have to say how high.
And of course, I like to remind our viewers that a central bank digital currency is, of course, a form of fiat issued by central governments that is programmable. So governments can decide which transactions can and can't be made. And governments will also be able to monitor every single transaction made, because the concept of CBDC is still seemingly fresh to many people. This is all happening at the same time, perhaps not coincidentally, as we're seeing the dollar lose its prominence on the world stage. We're seeing the declining role of the dollar on a geopolitical front, which I want to discuss now. That seems to have accelerated since Russia's invasion of Ukraine in February of 2022, where the dollar was weaponized. As I mentioned earlier, the BRICS, the Brazil, Russia, India, China, South Africa, they're meeting in August to discuss the introduction of a new reserve asset. China's already emerged as a major player in the system. Just last week, as we mentioned, President Xi Jinping and President Vladimir Putin met in Moscow, and they agreed to significantly increase settlement of trade using the Chinese yuan. And they basically said they want to see changes that we haven't seen in 100 years. I want to play you a quick clip from that meeting and get your thoughts. All right, well, in that clip, we had President Putin and President Xi say that they are going to make changes that the world hasn't seen in 100 years, calling each other friends. And they earlier pledged that they want to move the global trading system away from the US dollar. Is this de-dollarization trend accelerating faster than you expected?
Oh, I don't know that it's faster than I expected, but this de-dollarization trend it started back in December of 2002. So what's been happening is that it's been accelerating. And I mean, I don't know. I mean, this could just be a coincidence. But when you look at Saudi Arabia, I mean, the whole reason why the US dollar kept its position as the world reserve currency was because of the petrodollar.
Right.
And this talk of de-dollarization, it's accelerating, but they've been putting all the infrastructure in place for a number of years now. So this is not really new. But yes, I think it is definitely accelerating. And I'm wondering if it is just a coincidence that Saudi Arabia was a big backer of Credit Suisse, and then Credit Suisse put sanctions on Russia. And then all of a sudden, Saudi Arabia wasn't going to come up with more money to save Credit Suisse. So how much did they lose by, being, what was it, the largest or second largest shareholder? I mean, and Switzerland is more aligned with the US. So, I mean, is that a coincidence?
Well, the Saudis would say and did say that they didn't want to inject more money into Credit Suisse because that would have pushed them past the 10%, which was the regulatory hurdle that they didn't want to go over, of whatever the legalities are implied when you're more than 10%. But before we break down into that and the role of the Saudis here, I do kind of want to get you to just recap your thoughts on what you think of this meeting between Xi Jinping and President Putin, and what you make of this relationship between China and Russia and their vow to use the yuan and to move away from the dollar.
Yeah, well, what I'm seeing is that battle lines have been established. And this has been coming. I mean, we've been so arrogant in this country to export and show people that if you don't do what we want, we cut you out of the global financial system. So this is not a surprise to me, because this discussion and building out that infrastructure to be able to accommodate complete de-dollarization, even over at the IMF, with their substitution fund, they already set up the de-dollarization position on a global basis. Particularly, the IMF is part of this. And that is every Treasury Secretary and every central bank chief, almost, not 100%, but pretty close to 100%. So, yeah, I think that alliance is strong. It's alive. It's more surveillance oriented. And there is not one doubt in my mind, but that the U.S. is losing that advantage, because that advantage means that the whole world had to hold dollars. Well, if they don't have to hold dollars to buy oil, they can hold yuan. It shifts the power from the West to the East. And
right.
It's kind of like handing off the baton. But that can happen in a heartbeat, especially through the substitution fund. So those other countries, when they talk about their membership will expand, well, countries typically want to go to strength. And I don't think the US is showing a lot of strength. And I think that we're also forcing other countries whose currencies are pegged to the dollar into positions that they can't support. So we've been watching that whole shift in the global currency system. And yeah.
And speaking of errors, one could say that the withdrawal from Afghanistan and the debacle that signaled a real lack of faith in the US government with the way it handled that situation. And that put Saudi Arabia on alert, saying, well, maybe we don't want the US to maintain the role of protecting us as the agreement had been since the 1970s. And then they went and signed a pact with Russia for protection. And of course, Saudi Arabia is integral to this role of the potential BRICS currency. They want to be part of the BRICS. They've applied for membership. As we mentioned, China recently brokered a deal between Iran and Saudi Arabia. Let's understand the role of the petrodollar here, because Saudi Arabia, usually a US ally, has said that it's open to accepting yuan for payment of its oil. As mentioned, it's currently applying for BRICS memberships. Now, the Saudis have said that they're also building a $10 billion refinery and petrochemical complex in China. That's Saudi Aramco, which is the nationally owned oil company. Now, Saudi Arabia is at the crux of the US petrodollar system ever since the 1974 milestone agreement between Nixon and Prince Faisal. So the fact that oil is primarily traded in US dollars gives the dollar its power. How significant would it be for oil to not be sold in dollars?
That's the nail in the coffin. That's like that. Honestly, that's the last piece of the US dollar losing its world reserve status because, again, we're kind of arrogant, and we've alerted the world that you either do it our way or we're cutting you off. And the world doesn't like that. So that just furthers that shift. And to make it easy, there's already a fund where any country that's holding dollar-denominated assets can just deposit them into the IMF, and then the IMF can convert them into SDRs, and then you can convert the SDRs into yuan or any other currency. So, this is it. We are at the end now, whether or not China and Russia is going to be the next world reserve currency, the yuan or the ruble. That is, in my opinion, doubtful. I think it's more going to be the SDR because it just makes a whole lot more sense to me.
But we've also got the BRICS coming together with their different reserve currency backed by commodities, a collective reserve currency from all of these countries together backed by commodities, including gold, including oil. Do you not think that is the more likely replacement here?
I really don't, because it's not, I don't think it's broad enough when we get into this digital currency system. I think that they still need one that is more broad. And since you're talking about a basket currency that's backed by commodities. First of all, in order for them...
That could be a digital version of that as well.
Absolutely. But it has to be easily convertible. And I don't know that would be globally easily convertible like the SDR would be more easily convertible. And the weighting of those BRICS currencies can be much bigger inside of the SDR. All right. But then you'll have the global currency and you'll have the local currency. And that's what the dollar is going to end up being, is just a local currency.
So, Lynette, how do you reconcile these two ideas? I mean, does the U.S. want to lose its dominance on the global stage? I mean, surely not, because it's been such a source of power to have the U.S. dollar as the king of global reserve currencies. I
know that we tried to give back that status in 1969, back in that period of time. That's when the SDR was created because we tried to give it back. But sometimes when you just know you're at the end, then what are you going to do? And you're going to play into that so that you have some level of advantage. No, I don't think that we want to just give it away, because then we lose all of that advantage. And those that live in the US are going to feel the pain of that more than anywhere else in the world, because we've had this advantage for so long and we don't realize it. But it would be easier to do the de-dollarization using the IMF's substitution fund rather than, because a reserve currency isn't necessarily the world's reserve currency. It's just an additional reserve currency. Does that make sense?
You don't think that the US would not give up without a fight, that there could be a kinetic war to try and preserve this level of status that the US has enjoyed and many would say abused?
Well, that's the point. I mean, if you want to maintain a status, then you probably need to maintain allies. And from my perspective, when I see what the choices that we're making, we're pissing people off. We're pissing countries off. We're not really trying to maintain that alliance as well as we should. I think we're more bullying than we are cooperative. So
I guess it's a question. Firstly, do you see that there will be potentially a war to maintain the status, a physical kinetic war?
Well, I think there already is a war that's going on, and I think it's a proxy war.
Okay. The Russia-Ukraine.
I think we're already at war, and I think the other part is that the people are used to seeing boots on the ground war, which is this proxy war between Russia and Ukraine. But look at how much support we're giving one side, China's giving the other side, et cetera. So I'd say that we're already in that proxy war, but the real war is being fought in cyberspace. And that's something, again, that's hidden from the normal public to see. And some people think that that's been going on for a number of years already.
So, Lynette, help me reconcile this idea of, on the one hand, the US wants to blow up the current financial system. And as you've said, you believe that a lot of these missteps are, in fact, by design to bring everything down in order to facilitate a central bank digital currency, with the idea that we're having this trend of de-dollarization, but that arguably the US would fight against that. How do those two ideas sort of come together?
Well, number one, it isn't just a US issue. This is definitely a global issue, because everything that I talk about when I say about the devaluation and there's virtually no purchasing power value, this is a global issue. So the whole globe is resetting. Now, when you reset a system, then you're going to have countries that are going to step into that new position in a stronger position of power. Who has the most debt? Because all of that debt has to be burned off before they can put a new currency out there. Because as soon as you put those commodities and gold to back a currency, then that's going to fix the debt wherever that happens to be. And I don't care if you're looking at China, or you're looking at Russia, or you're looking at the US, or anywhere else. These debt levels, not that they're not sustainable, they're not payable. Right. And what supports all of these global currencies is the full faith and credit of the respective governments. And they've used that piece up. So the way that I can see it and the way that I reconcile it is, this isn't just a US issue. This is a global issue. And in order to push the agenda, they need a big enough crisis to get people just to follow along.
Right.
And it justifies everything. If there is a big enough crisis, if the global banking system implodes, and remember, we are all interconnected in a rather incestuous way. So it doesn't matter where this starts. It isn't really just a U.S. thing. This is a global thing. And we very well could be cooperating inside of this too, and not even realizing it.
Well, you could argue that the U.S. is trying to push a central bank digital currency because U.S. leaders foresee the de-dollarization trends unfolding, and the hope is that a CBDC could more easily retain its value as the digital version of the dollar, the Fed coin, if you will.
I definitely do not see the CBDCs retaining their values. That really is about control, and it's also about the ability to take away principal.
Yeah.
Negative rates attack your principal. They have already gotten globally, so all the central banks, all the governments have already gotten all of the purchasing power out of these currencies. Now they need to wipe it out. When they come out with a CBDC, it doesn't mean that this crisis is over. It's just the next phase of it. In order for us to know that the crisis is really over and when we are shifted into the new system, is when the currency is actually backed by a commodity. Because in a commodity, there's a finite amount, right? There's only so much gold, so much silver, so much oil, so much lumber, so much anything. There's only so much of it. And I don't even care if they find more. There's still a finite amount. Whereas in the current global system, there's an infinite amount. Governments can continue to grow debt as long as the public has confidence in their system. And then what that does is it shifts the wealth. So we could very well be agreeing on some level that we don't even know exists. I mean, we being the public really understand that that's happening behind closed doors. But the whole world has to go into a new system. This system is used up.
I hear you, Lynette. On the upside, though, recently, there has been growing awareness of central bank digital currencies, which to me is a big relief because I've known about this for ages, and I've been absolutely shocked and horrified that people that I interact with socially, arguably intelligent, well-informed people, hadn't even heard about a central bank digital currency or the idea that it's so potentially close to becoming a reality in the United States. I mean, that's even after Executive Order 16047 that President Biden signed into law in March of 2022. But okay, thankfully, we are now seeing some pushback on the mainstream stage, and there is some pushback from politicians, at least in the United States, against all of this. For example, we've had House Majority Whip Congressman Emma push back with the CBDC Anti-Surveillance Act. He said he wants to make sure that there's oversight over the Fed before any kind of digital currency is issued, maintaining that any digital dollar must uphold the American values of private individual sovereignty and free market competitiveness. We also had Florida Governor Ron DeSantis come out recently and say no CBDCs in Florida. South Dakota's Governor Kristi Noem has spoken out against CBDCs. Senator Ted Cruz recently introduced legislation to prohibit the Fed from establishing a retail CBDC, saying that it is a threat to privacy, to economic freedom, and warning how a CBDC can, in fact, be an Orwellian tool of surveillance and control. So with these signs of resistance, is this, in fact, inevitable, or is there a way, either through legislation or perhaps protest, that we can still prevent this?
Yeah, there is a way that it can be prevented. And like I said, you vote with your purse. You vote with your wallet. If you stay in the system, because let me tell you, you may have protests, but big enough crisis, all those protests are going to be silenced if they can be convinced that this is going to save the day. Mm-hmm. It's not. It is going to bring us into a full surveillance economy. And the other thing that I did want to also say, because you brought up a really good point, is that if enough people do this, then the government, if they buy gold, then the government is going to more than likely go in and confiscate. So it matters what kind of gold you buy, because if you buy what everybody else out there is buying, that's the kind of gold that is likely to get confiscated. But yes, if we all come together and we say, okay, we're not buying digital currencies, we're not buying stocks or bonds or this or that, we're buying gold, we're buying silver, and we're taking possession of it. This is what they can't control. Because of the probability, because I agree with you. I mean, history tells us that, and even current history is telling us that the most likely outcome is if the government feels threatened by people buying gold, that they'll take it away. So buy it in collectible form.
Why would that make a difference?
Well, it has historically, and since what the governments would use to justify it, just like the bail-ins, going back to the bail-ins, then they can take whatever they want. They just have to pay fair value, the eminent domain laws. So they control the spot market. They don't control the physical market. The collectibles are a physical only market. And you've got 1 ounce coins that can go for $15 million or more. So eminent domain laws wouldn't really quite apply so easily to the collectibles as they do to the bullion. Bullion is easy to do. You manipulate it, you give them a bonus, let's say it's at $3,000 spot is at $3,000 when they decide to confiscate and they say, hey, we'll pay you $4,000. Do a huge sweep of IRAs, depositories aren't going to go against the government. And most people not understanding that that's still not the true value will go, wow, look, it's only worth $3,000 and they're giving me $4,000. Okay. But they do, that's the way they do it. And then they reset this garbage that has no intrinsic value, and they do it against gold that's all intrinsic value because of its broad-based use.
Well,
so,
No. And Lynette, again, we pointed out last time we chatted that central banks have made record purchases of gold last year than ever before. But someone would say, okay, Lynette, you're in the gold trading business. You have an incentive to push this, to say gold is the solution, to tell people that, the world is going to come to an end, that there's going to be this collapse of the system, because ultimately you have an incentive, and that is that you personally are involved in a gold trading business. What would you say to counter that?
What I would say is that's why I'm in the gold business, because I've studied currency life cycles since 1987, and there are 100% of the time that there are repeatable patterns. And I kind of think if we've gotten the same thing, and there's been over 4,800 currencies that have gone through what we're going through right now, individual currencies, although it was pretty much global during the Depression in the 30s as we were making this transition. So I came to ITM in 2002 after the formulas confirmed that we were at the end of this currency's life cycle. So that's why I'm in the gold business. History, repeatable history tells you, shows you where you need to be positioned. Mm-hmm. Because wealth never disappears, it just shifts location. So you want to be in the right place at the right time with the right asset, and that right asset needs to hold your purchasing power. This does not hold your purchasing power by design. In fact, it has virtually no purchasing power left. The fact that you can still use it is just public confidence in the currency.
Right.
But that is eroding very, very rapidly these days. That's a huge shift. This is used across every single sector of the global economy. That's why. It's not because that's what I want, but this has the broadest base of buyer. And again, according to the Bank for International Settlements, no counterparty risk, and gold held at home, their words, not mine, gold held at home does not run political risk.
Right. Well, Lynette, as another I don't want to use the word gold bug, but as another person that advocates holding gold, another guest on our show, Jim Rogers, likes to say, the biggest lesson of history is that people don't learn the lessons of history. So thank you for giving us a recap of history and a recap of perhaps what we can expect for the present and the future. It's been a pleasure chatting with you as always, Lynette Zang. Thank you so much for your time. Thank
you for having me on, Michelle.
All right, we will see you again soon. And as always, thank you for watching Kitco News. I'm Michelle Makori. Keep it here.